All right, everyone. For those who don't know me, it's Shane Trades, co-founder of TraderLink, and today's class will be about a deeper dive into gamma exposure, and more specifically, what the positive bars mean and what the negative bars mean, and how price action kind of plays a role in that. Essentially, how dealers are playing with the price action or playing against it and whatnot, and how you can essentially read into that. So, starting off, let me pull up my lesson plan. So, the first thing I want to talk about is the gamma curve. So think about it like this. Let's get a nice little drawing. Think about it like this. I'll do it like this. That's a really ugly line, but okay. We'll make it work. So imagine this is gamma. So gamma. Shoot, there we go. Gamma. And then excuse me, I clear my throat. And then think about like this bottom is whether you're the strike price is the bottom, the y-axis. Let's draw a little curve like this, right? And then let's pretend that this is at the money, right? This is in the money. Going this way is more in the money, ITM. And then going this way is more out the money. So basically what the gamma curve tells you is essentially if you're more in the money and you're more out the money, obviously, as you can tell, the gamma exposure or the impact of gamma is going to be much lower, right? So this is more out the money, this is more in the money. So essentially, when you're at the money, that's when gamma is essentially where there's going to be the most impact, where there's going to be the most hedging activity. Does that make sense so far? I want to make sure everyone's kind of following along with that because this is very important. Okay, so continuing forward, since no one opposed. Okay, yeah. So essentially, for whoever didn't catch it, if you are out the money, or if you are in the money, or too far, or too out, or too in, right? What happens is essentially what it shows you based off of this gamma curve alone is that gamma is going to be the most in absolute sensitive and highest at the money. Why? That's just, that's just the way the graph works in the curve. So with that being said, this can explain why gamma is always or is not always considered a magnet, right? As we said on Monday's class, gamma is more so going to be your support and resistance, right, for the day. And that's just the basis of it. Gamma will not actually be always a magnet. It can be with under certain circumstances, and we'll talk about that, but it's not always the magnet. And the reason for that is because of the hedging activities. As you get closer to the strike price, or the strike price gets closer at the money, then the activity from the hedges pick up. And we're going to get into the said hedging activity on the gamma chart itself and how basically you can read the chart and go into that more, right? So both sides are out. No, one you have one side that's in the money, one side that's out the money. So if so long as once again just one more repeat of what I said, at the money is always going to be the most sensitive with gamma exposure. That's why when you hit a certain strike, or you hit a strike with high exposure, what happens is there's going to be some form of a reaction, whether that's a sell or a buy. And once again, we will get into the hedging activity portion for you to understand it and play and utilize it with price action, because that's what it does, right? That's the important part. As we talked about in a positive exposure environment, what happens? Dealers are selling the rips and buying the dips, right? They're dampening volatility. They're playing against price action. In a negative gamma exposure environment, they're playing with price action, right? So they're buying the rips and they're selling the dips. Okay. So continuing forward, the next thing is, and we'll get into this. I want to talk about quickly or shortly what's called the window of weakness, and that's important. So window of weakness. Let's start off with you have a timeline, right? For those who don't know, let's say this is end of month, so end of month. This is week one of the new one, week one. Do that wrong. So this is week one, right? Week one. This is going to be week two. This is going to be week three. And this is week four. And then this is the end of the month of the current month, right? Does that make sense so far, guys? So essentially, so getting into Vana and Charm and Gamma itself, there are certain exposures that will be more prominent at certain times. And initially, the basics of everything is that in week one, during week one, we'll use different color, right? For week one. So in week one, during this period, what happens is Vana and Charm are going to be their strongest, or not strongest, sorry. They come back into effect. Essentially is they have some form of effect again. So once again, I'll get into Vana and Charm. I'm just showing you guys windows of weakness and essentially when Gamma is the strongest and when you can utilize it the best. This is when Vana and Charm come into effect again, right? So come into effect, right? During week 2 through week 3, that's when Vana and Charm are the strongest. So V and C are the strongest, right? And then on week 4, or essentially in the middle or towards the end of week 3, depending on when OPEX lands, let's say usually it lands on the end of the 3rd week, right? So we'll call this OPEX, OPEX, right? At the end of OPEX till the end of the month, what happens is Vana and Charms, it's not that they lose their effect, it's that this is what's known as said window of weakness, right? Basically when they become, they don't have as strong as an effect or they're not as effective, right? So this is known as the window of weakness. Window of weakness, right? Of the Vana and Charm. So what does that mean for Gamma? Let's take a green color. If you do simple equationary math, I guess, per se. Oh, hold on. Well, it resets. So this is a little bit scuffed now and I can't click out of the tool. But what does this mean for Gamma? Gamma is going to always be the strongest right after OPEX, right? During the same period of the window of weakness for Vana and Charm is when OPEX, or is after OPEX, is when Gamma is going to be the strongest. That makes sense? So this is when, after OPEX, this is when you can utilize Gamma, where the hedging activity is going to be way, way more prominent than, the rest of the timeline. Does that make sense, guys? Then it slowly starts falling off. It's not actually falling off. However, it's that Vana and Charm come back into play, aka Gamma becomes slightly less powerful than it would be the prior time beforehand. Does that make sense, guys? So during week 3 to week end of the rest of the month, that is when Gamma is a Chad, right? What is OPEX? OPEX is the 3rd week of every single month where all options expire, where there's an option. Yes, exactly. Gamma is the GOAT at the end of the month, essentially. That is the best way to talk, to kind of visualize the window of weakness, right? That is when Gamma is going to be the strongest, the absolute strongest, right? This is just basic mathematics, right? Like this, like plus minus addition subtraction type shit, where it's like, okay, you have Vana and Charm where they come into effect, then you have Vana and Charm when they become the strongest, then you have that window of weakness, and what exposure do you go back to? Gamma. What is the gap between week end of month and week 1 on the left there? What do you mean was that? That's when Vana and Charm flows come back into play. Right here. That's when they come into effect. Then you have it when it's the strongest. Then you have the window of weakness where they're the weakest, and Gamma is the strongest or most effective. So you can kind of, if you put it into a calendar or like a month, right, then you can kind of visualize it yourself. Yeah, it is a bad drawing, but like, what is EOM? EOM is end of month and week 1 of the beginning of the month. Okay, you know what? We're gonna take a calendar then. We're gonna take a calendar, guys. Here we go. Let's do this. Okay, let's take a screenshot. This. End of month, start of week 1 or same day. Yes, effectively. Yeah, pretty much. I think. But let me just visualize this, right? So getting into it once again, right? Let's be specific. Let's use different colors to label everything differently, right? So end of month. Let's do start of the month, right? So this is week one. You have week one right here, right? There you go. And these colors are not working. So if I do it like this, then we expand, then we expand, and then we zoom. There we go. And then now let's take a different color. So week one, then you have week two, week three. OPEX is on the, let me confirm with the, OPEX in December. I believe it's the 15th. Yeah, third all Friday always. So it's the 15th. Okay, I just wanted to make sure. Is it the 15th? December OPEX is the 15th. Oh, this is interesting. You know what? We're gonna use January because there's a little bit less less noise. Actually, I guess this is fine. It's not a big deal. I guess they're just considering this week one then. Week one. And then you have this two leading to week 2 and 3. It's like partially 5 weeks, I guess, in December. That's why, because there's one day that falls into it. But boom. And then you have the time after OPEX, which is part of week 3. So this is essentially OPEX week, right? Oh, sorry, guys. Trying to make sure I'm doing this properly. Sorry. We got to make sure we have all the right labels. So OPEX week is its own week. There we go. Then let's do green, right? OPEX week. Boom. And we have the rest of the month. What color should we use? Orange, right? And we have the rest of the month. Boom. Like this, guys. Does that make sense? After OPEX, are the weekly gamma levels strong? You're looking at gamma levels. Yeah, essentially. That's pretty much how you can view it. On a regular like intraday time frame, the week after OPEX is going to be the absolute strongest for gamma because Vana and charm flows fall off. Right, this is that's just known as the window of weakness. So you go. Here it is, visualized in the month, essentially. Right. You have this is week one. Week one. This is week 2. This is OPEX week, where it gets its own week, right? And then you have the last post OPEX. So we'll just call it post OPEX. Now let's get another color. We'll do brown. Why not? Right. So Vana and charm flows come back into play here, right? Actually, that's a really terrible arrow. So we'll do like this. Vana charm, V plus C, come into effect. Come in. And then you have these 2 weeks. Like this, we'll do like a little bracket like this. V plus C are strongest. Strong. V plus C equals strong. Vana charm, we'll get into it with the rest of the class. I just want to show when the importance of this isn't so much the Vana charm aspect. It's where it's to show you where gamma is going to be the strongest, right? Because that's the main focus of this class, right? So, but here you go. And then this is when gamma becomes strong. So V plus C weak. And then gamma Chad. All right, does that make sense? So post OPEX is when gamma is the strongest, guys. That's it. I'm gonna finish that off with that. Gotcha. Yeah, go back, and if you need to see that, then you can go look at that. And then now let's go into the next segment, which is what is the difference between a positive bar and a negative bar on the gamma exposure chart? This is where it gets interesting, guys. This is what I love to explain. You know, I don't know if people know this or not, but this is where it gets interesting. So let's talk about positive gamma to start off. It's not that you, so, okay. I see where it gets a little bit confused. It's not that you should only focus on gamma week 3 and week 4 or post OPEX. The thing is gamma will always have a play. It's just Vana and Charm come in, and that's when you should be paying closer attention to those rather than gamma, if that makes sense. So it's a you can still use gamma solely and just utilize that for levels at the time. However, Vana and Charm come into play during that period. But once again, guys, no more Vana and Charm. I don't want to confuse anyone else anymore. We'll get into it. Just post OPEX is when gamma is the strongest and has the most reliability in terms of hedging activity. And once again, that's what we're getting into today. So taking a look at this chart, what do we see? Right, this is a positive positive gamma exposure chart so far, right? So let's take a look at this. Let's enlarge this. Okay, maybe not too big. We'll leave it right here and then we'll drag it out this way. Okay, what do we see here? What are the first things that I'm noticing from, a perspective of what I look for? I see this bar right here. What color shall we use? We will use something that's like, we'll use red. So look right here, 4,600 positive bar, big positive bar, correct? That's the AOI, obviously the area of interest as we talked about on Monday, but that's the first thing we notice, which is the largest bar is 4,600. It is a very large positive bar. What does positive gamma mean? Positive gamma exposure bars at certain strike prices will act like resistance or support depending on the approach of the underlying. Meaning since it is above spot, correct? Spot is right here. So pause exposure, pause above spot, right? Since it's positive exposure above spot, essentially what happens? Not every time is it going to be the same. However, in certain scenarios, when you see something like this, what does it mean? Keep in mind, dealers are not the only people in the market, right? You have bigger institutions. You have multiple institutions trading at certain levels. So when I see a positive gamma exposure bar above spot, what do I think? Okay, dealers are going to be trading against institutions, right? So if the market pushes up, right, to 4,600, what is going to happen? If institutions are buying up to 4,600 and dealers are trading against the current price action, what are they going to do? They are going to have to sell shares or sell as their hedge, and then it will act like resistance. This is what I mean is like, okay, let's visualize it on a chart again. Where's my trading view? Trading view. Let's take SPX, right? So we're here. So going into tomorrow, let's talk about this, right? Because this is where it gets interesting. Horizontal line, put it at 4,600. There we go. What's going to happen? So let's say, let's get the pathing tool. Path. Let's say dealers, right? We're going to have to go up, and dealers are going to have to sell against it. So what's going to happen at resistance if dealers are selling and trading against price action? We'll probably get some sort of rejection, right? However, once again, dealers are not the only ones in the market. So this isn't to say we're going to reject 4,600 every single time, right? This is just saying that dealers are hedging against 4,600, and they're hedging how? By selling, because they're playing against price action. They're going against the approach. So let's say now we get a bounce, right? And we get above 4,600. The strategy is the next time we get to above 4,600, or we get back down to 4,600, what's going to happen? Dealers are going to play against price action again. Since price is coming back down to 4,600, what happens? Institutions are selling to get it back down to 4,600. So dealers in turn will have to hedge against that and play the bounce, right? They're going to bounce it, right? That's essentially how you read the gamma exposure, right? Or a positive bar more specifically. Dealers are trading against price action. So if the market is below, and since guess what, there's 4,600 above spot, right? Dealers are going to push this up to 40, or institutions are going to push this up to 4,600. Dealers will trade against the price action by selling. We will likely get the probability that we get an initial rejection is probably going to happen, right? However, if we break above 4,600, that 4,600 is still a positive bar, so it will act like support, right? Does that make sense, guys? Dealers will be trading against it. Dealers into they are not the same entity. They are not the same entity. They can be. So think about it like this. Not all dealers are institutions, right? Some dealers can be, but they are not institutions. So they're not always going to be. That's what I'm saying? Is that at the end of the day, not every hedge fund is being delta neutral. Some are just buying long, some are selling short. Whatever the situation is they're not all the same. That's the big one, guys. Remember that. Not every dealer or not every institution is going to be a dealer, but some of them are. And however, even then they will be trading against the price action. That's just how gamma exposure works, is that it follows dealer positioning. It doesn't follow institutional positioning. Yes, it is very, thank you. Thank you, Phil. That's what it is. It's a very strict subset of essentially an institution. Not every institution is going to be a dealer, right? What constitutes as a dealer? They're just different market, I guess. You can call them different market makers, essentially. It's like a subset of a market maker, right? You have institutions, and then you have the subset, you have market dealers. This is where we would watch for the reaction of other bars above 4,600 to see if they react. Yeah, so okay. Let's take that for a second, right? Let's say we push up and we get above 4,600, but there is no pickup. Then what happens? They're probably still going to bounce this around here and they might chop it, and that's where you get sort of that quote unquote where people keep saying like, oh, 4,600 gamma magnet. Gamma will not always be a magnet, guys. I just want to make that very clear. Gamma will not always be a magnet. It can act like a magnet under certain circumstances if there is certain Vana effects on it, if per se. But we're not going to get into that today. That's for the rest of the courses or the classes going into the next week. We'll get into that. I promise you, because it's very important. I want to make sure everyone understands gamma first, right? Because without gamma, you're not going to understand the other shit. This is gamma is one of the easiest things you can implement to your trading, essentially. And that's what I want to talk about, is like that's the important part. Vana and Charm are harder to understand, but gamma you can easily implement into your trading. But does this make sense so far? Depending on the approach, since it's positive exposure above spot, if institutions push it up, dealers are going to trade against price action, bring it back down, right? It becomes 4,600 acts like resistance. If we break above 4,600 because institutions overbought, right? And guess what? Dealers are going to have to bring it back, or they're going to bring it back down. And per se, if we tap 4,600 again, 4,600 positive exposure is below spot price, then it will act like support and dealers will start buying. All right, now that we're done with this section, here's the cool part in why negative exposure is so much more fun to trade with or trade around, right? Let's get into that one. That's the fun shit. So negative gamma exposure, what is it? It will assist whichever move is happening through that strike, right? So instead of being a dampening effect, it will assist certain moves, right? So let's get into it like this, right? Let's just use this for now. Let's say, market is chopping like right around here, blah, 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 we're chopping around, but we have a large bar at 46.15 right here, right? You see it on the chart right here, 46.15. What happens is if we get to 46.15 and what are dealers going to have to do? If we get to a negative exposure under spot price, right? Dealers will be trading with price action. No, not buy. They will not be buying. It is negative exposure under spot price. And as I said, negative exposure, what do dealers have to do? They have to assist whichever move is happening. So if institutions are selling through this, guess what? The approach is coming down. So dealers are going to have to sell with the move. They're going to sell the dip, right? As I said, in a negative exposure, guess what happens? Dealers will be selling the dips and buying the rips. So guess what? We come down. Dealers have sold through the rip alongside institutions. Guess what? This is why you always see those V-shaped recoveries, guys. This is super, super cool to see. It's honestly cool. It's cool in the sense where it's like kind of mind blowing. It's like, okay, this is super cool. I may sound like a nerd, but whatever. That's beside the point. Yeah, exactly. There was one day we came down and there was an exposure at 43 or 45.65 and 45.70, right? And we popped past that. So then guess what? Let's say, dealer or institutions are done selling, they're starting their buyback, that's where you get the slow, tiny baby movements here. But guess what? We start climbing up. We start climbing up. We start climbing up to what? 46.15 again. What happens? What happens, guys? It's still negative exposure at 46.15, although it's negative above spot. Guess what? Negative exposure. Guess what it is? It will assist the move. Exactly. More buying. That's when you see the rip through of the gamma exposure levels, guys. That's where you get that rip through. Dealers are buying through alongside the institutions to get through that 46.15. They're assisting the move. No, we're talking about the bar. We're talking about the bar, guys. We're talking specifically about the bar. Let's say this 4,600 was a negative bar, right? Instead of positive. So it's going downward and it's really big. It's 4,600 AOI, but it's negative, right? So, but that's what I'm talking about, guys. Is this true in both positive and negative total gamma environments? It essentially, I want to say yes, it can be. Yeah, gamma squeezes tend to happen more often in negative environments. And that's when dealers have to, they get screwed over. So they end up moving with them, playing with them. Holy shit, so many things to read. Yeah, so that's essentially why split divergence can also do some wacky shit sometimes. Gamma squeeze only having okay, so it's easier. It's not that it's easier to play with negative gamma, it's just that moves are going to always be more prominent. So negative gamma exposure at certain strikes act like accelerants for fluid movement. As I said, that's when you get those bigger moves through those exposure bars. Looks like gamma is more fun to trade. Yeah, I 100% agree. It is always more fun to trade with a negative gamma exposure because guess what? Volatility is going to be heightened. Volatility will be heightened because guess what? They're playing with the price action. They're going to be more vigorous. The moves are going to be bigger. Negative. It's okay. Lloyd, to be more specific, negative exposure is sort of like it. I mean, if you're talking about big rips and as in not just upside, but just big rips in direction, yes. Positive exposure, well, you'll tend to get more slower price action. Yeah, negative gamma creates more volatility. Net positive dampens it. How's gamma formed then? What do you mean how's gamma formed? I mean that's like what makes gamma. There is a whole complicated formula. It's like math. Also nice trades for that. Yeah, it's nice to trade spreads on positive gamma, like especially like okay, there's a reason for that, and it's very nice. And we have a very specific trader in the chat. He's an Apex trader in the Discord. If you're in that one, what happens is he trades spread. This guy makes he trades spreads like butter. He basically will identify the gamma walls and he'll wait to play them and he'll pick contracts or he'll sell spreads that are in the money and they'll go out of the money by the end of it because he knows exactly where the market's going to go based off of gamma, which is the cool part. Yeah. Okay. Sometimes when gamma is negative, market could keep dropping. Yeah, because dealers are trading with price action. So they can continue to rip it down. Right. So it's following the price action. Will you go over the formula for this class AOI minus hammer? AOI minus high gamma level for support. That's that's not very useful as much anymore. So that's based off of the old cheat sheet, so it's not as important. So here for the optimal strat is to not short under negative exposure if not already short, but more wait for the consolidation goes by. It depends, right? You want to make sure that you're near that exposure is like so a good way to trade this is like, okay, if you can have a strategy that already bottom ticks certain shit for you, right? Then you can take those and then target those gamma areas. And when you get to those gamma areas, man, there's probably going to be some sort of move up, right? They'll trade with the price action. Not entirely. You can have certain sorry, the example is where we have negative gamma being negative gamma above spot. Yeah, so it goes through the negative gamma exposure, but there's no pickup of any other exposures below. like negative exposure below, then it'll probably chop around. Then it'll, and let's say 46.15 is just, since that's just where this one's at, it stays prominent and we get back up to 46.15, we will essentially get another move potentially through it. I don't know if it's considered a put wall because negative gamma exposure is like you got to play with the delta there. You got to play with the deltas because if it's because puts carry negative, like bought or yeah, purchased puts, bought puts, long puts. There we go. Long puts have carry negative gamma. Short calls also carry negative gamma. Yeah, Phil, that's a good way to talk about it. If neg wall breaks, short it, but be ready to exit whenever recovery starts. Yeah. The no pickup below is like, yeah. So think about it like this, right? Let's say now there's a pickup right here. There's a pickup below. All right, let's delete this. Think about it like this, right? Let's say we chop around and whatnot, right? And then we get below this. They're going to assist through the move. And then let's say once again, there's another pickup. There's another small or short negative gamma at 4,600 here. They're going to assist the move down below it too. We may chop around and let's say 4,600 stays. Then when we get back up to 4,600, guess what? We're going to rock it back up. We're going to go through it again because they're going to assist the move. It's an accelerant, guys. Gamma flips are just they act like support and resistance. That's typically how we view it. It's the simplest way. So like at 45.60 here, you have the gamma flip. That will act like a support because it's below spot. If it's above, it'll act like resistance. Do we have any live streams? No, these are live trades. No, we don't stream trades. We don't do live trades. This is strictly a data platform. We present to you guys the data so that you guys can make your own informed decisions. We teach you how to chart the data, how to utilize it, what to look for and stuff like that, but we won't call out. That's just, we're not a signals Discord. That's not what it is. We're here to just teach people how to utilize the data because it's what's the point in following someone, right? At the end of the day, like if you're a signal Discord, and I know there's two in here that I have very high respect for. It's Jay and Ace. Look, at the end of the day, they don't want you to follow them. They want you to learn from them and then make the decisions on your own. And at the end of the day, if you since they helped you get to that point, they just want you to stay in the community. They could care less about your money. They just want you to stay within the community because it's fun, right? Trading with people who helped you, who taught you. From your training data, how can you use advanced Greeks during this month's mega confluence of OPEX, PPI, FOMC? So, in my personal opinion, usually, unless you're getting that gamma magnet effect alongside with Vana, right? Because as I said, gamma is not always going to be a magnet. But you will have, in certain situations, it can be with the help of Vana, right? That's where it's kind of having that magnetic effect. It's not always going to be sort of a gamma magnet, but people just call it that because it's they don't know as much. Is gamma live as in during the market is predetermined beforehand? Is gamma live as in is it? I mean, this data is for tomorrow, so it is live right now. Like this is what they're positioned in for tomorrow. Spot price is the gray one. It's currently at 45.85. Refresh rate of the data. It currently refreshes every single minute. Yeah, 4,600 tomorrow. I don't think we'll break through very easily. Yeah, since it's positive, this is just my take. The thing is once again, it's dealers, right? So if we do break through it, then guess what? Wait for when we get back above, or sorry, if we break above 4,600 and we start, let's say we get to 46.10, 46.15, and we retrace back to 4,600, then that will act like support. 4,600 will act like support because dealers will have to be buying. Isn't that cool shit, guys? I was super hyped to teach this class, honestly. It's just cool. It's like interesting stuff. You know, you don't see much about it, and it's understanding the hedging mechanics that makes everything interesting. Yeah, you can predict the closing strike, and we've done it multiple times. It's however, you know, things are always subject to change. So gamma exposure, I have this written somewhere. I wrote this down for you guys. Okay. Times where gamma can be a magnet is essentially closer to expiration. So, you know, towards the last power hour where it gets interesting, last 30 minutes, last 10, 15 minutes is where it gets interesting. So times where gamma can be considered a magnet is closer towards expiration. And the reason is that the adjustments in the hedging can be way more pronounced, potentially causing the stock to gravitate towards the strike with the highest gamma exposure. The concept is more noticeable when there's a large amount of options at a certain strike that are about to expire, creating this effect. And as we call gamma pinning. You can look up that term. It's gamma pinning. No, the software isn't free. The software is it's $100 a month. We have a weekly trial for $29. Are the adjusted gammas work for you? The Lotto EOD with the highest gex. I mean, you can do that. I'm not here to give investment advice, guys. So don't ask me like lottos or like what to take. Anything serious? Can we? Anything serious? I'm happy that it's helping clear up everything. So there's also this like stabilizing effect that not many people talk about. Essentially, is like while certain strikes can act like magnets, it can cause, so it's not always going, it depends on like where you're at. So let's say you're at 4,600 and there's nothing interesting happening in terms of general price action. That's sort of like the stabilizing effect. It's essentially when the stock price tends to gravitate to certain strikes. So let's say 4,600, for example. So let's say it tends to just keep gravitating towards 4,600. So it creates sort of like the stabilizing effect at certain levels. Um, and basically, and the reason for that is just because dealers are making continuous adjustments. So it creates that sort of like dampening effect on overall price volatility, especially when it's closer to the expiration dates. Adjustments will always be more frequent. Are gamma levels a week out hold any weight since gamma level changes intraday? So we're coming out with what's called aggregate gamma. So for those who have been with this platform know what I'm talking about, but for those who are newer, what aggregate gamma is you can take all the gamma and on our charts and it'll add up the certain the range for the expiration date. So you can basically go to the calendar, select the date. So let's take today all the way till next Friday, and it'll give you the aggregate gamma instead of like picking one day at a time, right? So let's say 12/15, we view the gamma for December 15th OPEX. Sorry, my dogs are growling. But aggregate gamma will take everything. The charts are real time, but can I back test? If yes, how far back? Um, so as of right now, we don't have historical data, so you cannot really backtest. However, if you are a sub, what we do offer for Discord users, oh yeah, Liquidos also. Oh yeah, Liquidos posts the videos for SPX every single day. Uh, Liquidos, link your YouTube. That's good. He links it with his or he has a trader link dashboard plus the SPX chart for people to look over. Um, oh, that's huge. I don't even have to talk about the screenshots. Awesome. But yeah, guys, that's pretty much it for today. That's just like I it's it's not a lot of information, but I feel like it's really good information. You know what I mean? All right, I'm gonna cut this the recording for now because it's I mean that's all the information I wanted to get out there, but